California exit tax. When is it due? How do I calculate it? How much do I have to pay? How does it work? Hello everyone, my name is Javier Correa and I'm a licensed enrolled agent in the US, and today we're talking about California exit tax. Who does it apply to? What do we have to know? So the first thing I want to say out there to everyone who follows this channel and who wants to do research on California taxes is that you have to know that California exit tax is a myth. And no, this is not an April Fool's video. It is the truth. There is no exit tax in the state of California. Now, like many myths and like many common conceptions out there, it is based on something that is partially true. The fact that California lacks exit taxes, and by exit taxes I mean a deemed disposition on assets when you leave the state, for example, or a departure tax, or something similar to the exit tax when you renounce your citizenship, or departure tax when you leave the Canadian tax system. Even though something like that does not exist when you change your tax residence from California to, say, Florida, what does happen is that the state of California does have very strict rules on who it considers tax resident and who it does not consider tax resident. So what ultimately does happen is not the existence of an exit tax per se, but rather a constant situation where in many cases people believe they've left the state for tax purposes, they believe they have established tax residence somewhere else, when in reality under California rules they can still be considered California tax residents. So as a reminder in general, U.S. citizens are subject to worldwide taxation and are considered tax residents of the U.S. regardless of wherever they are in the world, meaning that you can be a U.S. citizen living in Ireland, living in Costa Rica, living in Panama, living in Barbados, and you will still be considered a U.S. tax resident. However, at the state level, so not at the federal level, but at the state level, Americans can choose from among the 50 states where to establish their state tax residence. This is why, for example, in recent years, we've seen a huge influx of billionaires moving to Miami, to West Palm Beach, to South Florida in general. People like Jeff Bezos and Mark Zuckerberg relocating to Florida, because in Florida you don't have a state income tax. So obviously, even though you still have to deal with the federal government, the reality is that at least by moving to Florida, you get a break at the state level. So obviously this is something very powerful, and it has motivated a lot of high net worth individuals, many of whom are our clients, to migrate from California to more tax-friendly or tax-free states like Nevada, like Florida, like Texas. So ultimately for Americans, it becomes a question of how do I break tax residence with California in order to relocate to a tax-free state, or potentially to relocate abroad. I have long time said to many of my clients, at certain levels, especially if you're, running your own business as a sole proprietor, or maybe you're a partner in an LLC, or maybe, you're a very highly paid freelancer, it would be interesting to consider and compare how your numbers would look in terms of tax exposure if you decided to relocate to, let's say, Panama City, Republic of Panama, as opposed to Miami. But anyway, going back to topic. Here we have a couple of items, and I will list them so that you can have an idea of what are the main issues that former California residents face when essentially claiming that they are no longer tax residents of California. Number one is not spending enough time in the new state or the foreign country. So this happens quite often. Let's say, you're from San Francisco, you're in the tech industry, and you want to claim California tax non-residence, and you say, that you've moved to Nevada, right across the border from California. Nevada, obviously a tax-free state, much more advantageous. You buy a place in Las Vegas, okay, great, but you're spending, a lot of time in California, and then, you're traveling back and forth, and then you're traveling abroad on business, and when you end up showing, your the time spent throughout the year in different places, you're hardly spending any time in Nevada. So when that happens, California can very easily claim, well, you haven't really established a new home at the state level in Nevada because you have hardly spent any time in Nevada whatsoever. Point number two, keeping a California family home and using it regularly. So this is also something very important. For people who, for example, are married and have kids, if your wife and your kids stay back home in California, that's going to be an issue. In addition to that, obviously having a permanent home whatsoever in California. So having a home available to you in California is going to create a link that is very important to California that could be used to potentially drag you back into the California tax net, or rather than dragging you back, just simply allowing the California tax authorities to claim that you've really never left. Number three, as I said before, spouse and children remaining in California. It's very important. I actually want to reemphasize that because I work with a lot of people who do international relocation that is tax motivated for tax planning purposes. They want to optimize their lifestyle as well as their tax exposure. And in many cases, the wives, the girlfriends, they want to stay behind. That could be a major issue. Now, obviously, on the personal side of things, that's up to all of the gentlemen to discuss with their female partners, but it is something that we have to take into consideration when we're doing tax planning. Where your wife is, where your family is going to be of great importance, and it is also very important for California. Number four, continuing a California employment or business relationship, or having employment or business ties to California. This is very important because obviously California has a massive tech industry, massive film industry, and a lot of the people that we work with unfortunately find themselves in a situation where they can leave and they do everything right. They bring their wife, their kids, they do everything the right way, but even if the wives and the children are outside of California, and even if they've sold their home, the problem is if you have substantial ties to California from a business perspective, that could also be an issue. And then obviously if you're employed by a California-based corporation, that can always potentially be an issue as well, which creates a link to California that could be used against you in terms of establishing that you've never left California for tax purposes. The other thing is completing formalities like licenses and voter registration, but not changing actual life patterns. So this is something very important. So I think there are two dimensions to this. Number one is actually completing the formalities. I can't tell you how many times I've had clients that claim they've left and that they've relocated to, say, Florida or Texas, but they don't have a Florida driver's license. They haven't updated their address for banking purposes. They're still using a California mail forwarding service, and ultimately they're still registered to vote in California. So obviously, if you're in that situation, then it's going to be very fragile. There are a lot of arguments in favor of keeping you in the California tax net. And then obviously, remember, substance over form is always going to be very important. So even if you do all of these things, even if you follow all these formalities, and that would be the form, there has to be substance. You really need to establish ties with your new state or the foreign country. So for example, if you're going to Florida, it's recommended that you if you're going to be in Miami, start joining clubs in Miami, start going to church in Miami, register to vote, participate in local events. Like those ties and your ability to establish a true domicile, meaning the intent to remain in that new state, is going to be very important for a successful California exit. And then finally, failing to provide records proving the move or proving days spent outside of California. So this is another point that I think is very important, and it applies to people moving within the U.S., but it also applies to people who want to claim certain benefits that are only available for Americans who live abroad, like, for example, the foreign earned income exclusion. And it comes down to, unfortunately, people who are tied to high tax jurisdictions, whether it's California or the U.S. in general. You need to keep track of where you have been. So there are apps that help you do this, but ideally you should keep a calendar and you should keep track of where you've been, how long you were there for, what was the purpose of the trip, etc., because this is going to help you in the event of an audit to prove that you've actually have a departure date that is defensible, that is trackable, prove how much time you spent in your new home, prove how much time you've spent traveling for business or anything else. It's going to be crucial to track those things in order to have and to claim tax benefits, whether it's at the California level or at the U.S. federal level. So keeping track of where you spend your days is going to be absolutely crucial. Now, there are other things that obviously have to be taken into consideration. Remember, taxes is very facts and circumstances driven, and each individual case is different. But here I wanted to give you the broad strokes of the common mistakes certain people make when they're not working with professionals and they're just doing things on their own, and they believe they've left California when in reality, the California authorities will still consider them tax residents of California. So if you're considering leaving California and you're considering something international, you're looking at Panama, you're looking at Barbados, you're looking at Costa Rica, you need a cross-border tax expert like the Rothbard Group to help guide you throughout the process. And hey, if you're considering moving from California to Florida, you still need a tax professional to help guide all of the elements and help direct all the elements in the right way to make sure that California doesn't have any tools available to it to still claim that you're a tax resident. So, until next time, rothbardgroup.com. See you in the next video.